Today will be the Thursday, the 21st of August, 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap first. What has taken shape yesterday in terms of news flow, key economic data release, as well as in today's early Asia session before the start of our daily dose at 11 a.m. Singapore time. So yesterday, in terms of economic data, let's have a quick look at the economic calendar. So we do have one particular important data that is surrounding the inflationary trend of the United Kingdom, which is UK economy over here. Yeah, just a couple of seconds. Yeah, the screen is out. Good. All right. So core inflation rate came in at higher than expected for UK. All right. So market is expecting a same pace as the previous month of June, which is at 3.7%, but it came in at 3.8%. So yesterday's core inflation rate inched up higher by 1 basis point to 3.8%. So what we could see over here is that it's the highest figure since April. And if you look at the 5-year trend, it's rather still remains elevated since the 3.2% December 2024 print. So since end of last year, core inflation trend in the UK economy is not coming down, but rather is slowly inching upwards. So it still remains rather elevated. So that being said, potentially Bank of England should potentially remain rather cautious for the rest of this year, and we may not even see a potential so-called rate cut in the near-term horizon, given such elevated core inflation rate number for the month of July. But that being said, over here, yesterday, we do continues to see the US dollar showing some form of strength against the sterling. So later I'll share with you what is the short-term intraday technical outlook on the sterling versus the dollar over here. So another data that has taken shape early today's Asia session will be the release of this global PMI flash data across the globe for major economies. So what we could see at this point in time, what we have the core inflation data, not core inflation, pardon me, the Australia manufacturing PMI flash data that came in better than expected. Slightly above the previous month print of July of 51.3, it came in at 52.9, and the services PMI for Australia also came in slightly better than the previous month of 54.1, which is in July, and it came in at 55.1 for the month of August over here. And Japan, rather mixed bag. So Japan primarily centered on the manufacturing. So yes, we still see a contraction, but the rate of contraction has started to slow down. So we know that PMI, anything that is below 50 still represent contraction, but the rate of contraction has started to slow down for the flash figure for August. So for the month of July, it was 48.9, market expecting a recovery to 49, and the actual number for the flash August reading came in better than expected as well at 49.9. For the services side, data for August, preliminary data for Japan came in, is expanding, but expanding at a slower pace this time around. It inched down slightly lower to 452.7 for the flash figure of August from the previous July print of 53.6. So net overall is rather a mixed bag performance in this one set of the tier 1 leading economic data for Japan over here. So later I'll share with you the Nikkei 225, which is Japan 225, and the dollar yen short-term intraday technical outlook on that. And also Now, let us now shift back to the performance of the major FX dollar pair, and or I'll say the major currency performance. So the 5-day rolling performance of the major currency against the US dollar. So I would like to repeat again, how do we read this? Is actually using dollar as the base currency. That means $1 equals to how many Kiwi, $1 equals to how many Aussie, and $1 equals to how many sterling pounds, and so forth. So we could see the clear outlier was the Kiwi yesterday, where the dollar strengthened tremendously by 1.67% as we are speaking right now, based on this 5-day rolling performance. So the reason of this dollar's pronounced short-term dollar strength against the Kiwi was that ultra dovish monetary policy guidance portrayed by the New Zealand Central Bank (RBNZ), where yesterday, as expected, they cut their benchmark OCR interest rate, that's the short-term interest policy rate, to 3%. That's as expected, to a 3-year low. But what they portray to the market, that their interest rate cut cycle is not ending soon, and they kind of give a hint that potentially there could be 2 more interest rate cuts in store in the near future in New Zealand. So that actually explained to us the pronounced dollar strength against the Kiwi. And we know that in some form, based on a direct short-term trading correlation, the Kiwi and the Aussie dollar tends to move hand in hand in direct fashion. So the weakness of the Kiwi actually drag down the Aussie dollar as well. So we start to see the dollar strengthening against the Aussie yesterday as well. And as for the rest of the major currency against the dollar, it's kind of a more like a flattish trading range configuration over here, but the dollar continues to inch up against the sterling. What we could see over here, that is up by 0.55%. So the dollar is strengthening against the sterling, despite that so-called hotter than expected core UK inflation data, which I shared with you guys earlier on. So the reason why the dollar is strengthening against sterling is could be due to positioning ahead of this key risk event that is taking shape on Friday, which is at 10 p.m. Singapore time. So that is the Fed Chair Powell annual Jackson Hole Symposium speech over here. And interestingly, the dollar yen continues to remain lackluster, trading down negative 0.3% as being trapped within a medium-term ascending range configuration. So I'll share more about that when I cover the dollar yen intraday technical outlook. So onward next will be the movement of the intraday movement of the US stock market. So the US stock market continues to see profit taking primarily in those benchmark stock indices that is heavily weighted to the mega cap technology stocks. So the SPX is down by negative 0.24%. The Nasdaq 100 is down by negative 0.6%. The Dow Jones Industrial Average continues to trade flat for the second consecutive session, and the Russell 2000 is down by negative 0.3%. So if you look at the S&P heat map over here, we continue to see a sea of red among those mega cap technology stocks. Those are very clear, represented by the bigger, we call it bigger rectangle sizes, right? So they represent their market cap. So Microsoft was down negative 0.8%, Apple down almost negative 2%, Amazon negative 1.8%, Google negative 1.14%, Meta negative, not that much, negative 0.5%, and Nvidia managed to have a trim losses at 0.14%. So what I could see over here is that it's not totally a sea of red. That means we do not see a kind of a across the board sell off among the S&P 500 component stock, but however is due to the weakness in their mega cap technology component stocks that dragged down the intraday performance yesterday of the S&P 500 and the Nasdaq 100. So if you look at the sectors, the 11 sectors that's comprising the S&P 500, so very clearly not all of them are in the red. So in fact, there are more sectors that are trading in the green versus in the red. So the red sectors were the industrials, down slightly negative 0.2%, communication service, which has 2 mega cap technology stock weightage in it, which is Meta and as well as Alphabet, which is the parent company of Google, down by negative 0.5%, and the technology comprises of Nvidia and Microsoft, which is down by negative 0.73%, and consumer cyclical down by -1%. But overall, we do see a bit of defensive coming into play and supported by financial as well, which is up by 0.5%. So, and also the reason why the technology stocks or the chip, especially those semiconductor chip makers, were hit yesterday because there's this, okay, the semiconductor chip makers were hit yesterday because there's this particular news as reported by media stating that US government may consider taking stakes in for chips grants. All right, so any particular US semiconductor that has this awarded these chips grants will face this risk of US government taking certain percentage of equity stakes in them, which the US government has starts to we call it take up government stakes in Intel over here as they try to actually cement US semiconductor positioning in the US economy. So that means if the US government starts to take stakes in US semiconductor firm, for those who take the chips grant, that means i.e. whatever commercial decision that these chip makers do, the US government will has a say to make a decision, given that now they are considered significant stakeholder. So that may actually reduce the commercial viability of such US semiconductor business model. And given the US government has a stake in them, so they now got to balance between commercial element and as well as national security element. So the net result in the longer term, it may not bode well for net profit growth. So that actually explained to us the semiconductor weakness that's been seen yesterday, which is a major sector component weightage on the S&P and the Nasdaq 100. So that also explained the second consecutive day of, in fact, not the second, be the third consecutive day of the S&P and the Nasdaq 100 underperformance against the Dow Jones Industrial Average, which does not has a significant component weightage on this technology related sector or stocks. All right, so now next over here is that one more thing I want to share with you guys over here is that yesterday we have the release of the US FOMC minutes. That was the previous minute over here in July. So in the previous meeting, the minutes showed that most of the Federal Reserve officials highlighted the risk to inflation as outweighing concerns over the labor market at their meeting last month. So bear in mind, the FOMC meeting last month was actually taken shape prior to that weak non-farm data print over here. So just take this as a pinch of salt over here. So ahead of the key risk event, which is on this Friday, that is Fed Chair Powell annual Jackson Hole symposium speech, the CME Fed Watch tool, which consists of the data being aggregated from the Fed Funds futures market in terms of the probability that's being assigned to the next upcoming FOMC meetings, whether there will be a cut or hold or a hike. Market participants in the Fed Funds futures market is still assigning a high probability of 82% that the Fed may reduce interest rate on the next meeting on the 17th of September by 25 basis points. So the current rate is 4.25% to 4.5%. So market is looking for you to reduce down to 4% to 4.25%. So that's a potential 25 basis point cut. So the probability has been pretty stable over here. So yesterday, a day earlier, it was at 86.6. So the latest one now is down slightly to 82%, which is still pretty high, I would say. So if you go down the calendar for the next few meetings after 17th of September, so market is still assigning a high odds that the next interest rate cut will come into the last meeting of 2025 at 85% chance to bring the Fed funds rate lower by another 25 basis points. So that could be a potential second cut of 25 basis point to bring the Fed funds rate to 3.75% to 4% before 2025 ends, that will be on the 10th of December FOMC meeting. So nothing has really changed. So despite the FOMC minutes released yesterday stating that most Federal Reserve officials are concerned over sticky inflation or elevated inflation over softness in the labor markets, but that doesn't change the expectation on the Fed Funds futures traders mindset or trading pattern, given the fact that the FOMC minutes is more kind of lagging and they didn't actually take into account of that later release week print non-farm payroll data for the month of July that was actually released later than the previous month, the previous FOMC meeting when that's taken shape over here. All right, so with that, that sum up the first segment of the daily dose. Let me now move on to the second segment, which is the intraday technical outlook segment. So let me expand my script over here. So let me start with the FX market. All right, so the FX market, the euro dollar continues to remain lethargic. It's going to print a series of higher low over here. Low, it's going to print a series of lower high, not higher low, lower high. Okay, a bit of tongue twisting. It continues to trade in a series of lower high. So what I could see is that yesterday it managed to survive at our first support level at 163 figure, but there's a bearish reaction at this minor descending trend line taken from the minor high of 18th of August and slightly below our pivotal resistance that we highlighted yesterday at 160.90. So I'll be watching closely this 160.90 short-term pivotal resistance level, still maintain that short-term bearish bias on the euro dollar for this potential minor corrective decline to extend slightly downwards further to retrace certain portion of that former minor uptrend phase that has taken shape from 1st of August to 13th of August over here. First support level to watch remains unchanged at 163 figure. A breakdown below 163 figure will expose 116 figure, 115.90 next, which is a pretty key, interesting short-term support zone, which we have a former fierce battle between the bulls and the bears, previously a clear congestion area from 4th of August and 11th of August over here. All right, so that is also constitute 38.2% Fibo retracement of that prior minor uptrend up move as well. Only a bullish breakout above 116.90 will invalidate the bearish bias to see the re-emergence of the bulls to retest 117.30, followed by 117.70 and 117.90, which is the minor swing high area of 24th of July and 28th of July. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar did a bearish reaction right at the 50-day moving average. So that's our first resistance zone that we have, 135.10, 134.95, where we flip to a bearish bias below the 135.40 short-term pivotal resistance that we have yesterday. So what you could see is that the RSI still continues to remain lackluster over here, doing a lower high below the 50 level mark, and it hasn't hit the overt sold region yet so far as we are speaking. Right, so what I could see is that with this lackluster RSI reading below the 50 level, indicating the lack of upside momentum, we will still maintain that bearish bias for this potential further extension of this ongoing minor corrective declines sequence, still using the 135.40 as my short-term pivotal resistance level. Support zone to watch will be at 134 figure slash 133.70. That remains unchanged, which is confluence with the 20-day moving average as well, and as well close to the 38% Fibo retracement and the 50% Fibo retracement of the prior minor uptrend move from 1st of August to 14th of August over here. So once it hit this 134 figure slash 133.70, I'll be on the lookout for any signs of a bullish reversal candlestick to potentially attempt a bullish reversal price action movement over here, given that potentially this down move may get exhausted at this region over here at 134 figure, 133.70. Only a sudden bullish breakout above 135.40 today with an hourly close above it, that would invalidate today's bearish bias to see the resurgence of the bulls to retest 135.90 / 136.10, which is the minor swing high area of 14th of August, followed by the next resistance zone at 136.50, 136.80, which is a previously a Fibo extension cluster level as well, and the former minor congestion area of 4th of July, and the minor swing high area of 8th of July, followed by 8th of July. We can see over here. So that's for the sterling dollar. Next up will be the Australia dollar. All right, so the Aussie dollar continues to move down lower as expected over here, hit our first support level at 64.20. So given that the next support zone will be at 64 figures / 63.90, which is very key, this will be the expanding wedge range support taken from the low of 23rd of April. All right, so if we go all the way down over here, it's the 20th of April. So this is the lower limit of this expanding wedge. So considered as the expanding wedge range support level. So given that it's now coming very close to our desired support level, but what we could see over here is that the RSI is not showing any signs of a so-called, very interestingly, give a minute. All right, so very interestingly, the RSI, what we could see over here is that if I were to zoom out, okay, it started to trace out a bullish divergence. All right. Okay, so it started to trace out a bullish divergence. All right, so with that, I will actually now flip to a bullish bias, given that a bullish divergence has already been formed on the hourly RSI for the Australia dollar. Okay, so this is the Aussie dollar over here. And also it's coming very close to our desired support level as well, 64 figure, 63.90. So given this bullish divergence, there could be some kind of bounce around this area here that may unfold, given that this bullish divergence represent downside momentum on a very short-term basis that starts to ease off. Right, so with that, I will use this level 64 figure / 63.90 as my short-term pivotal support for today. All right, so first resistance level to watch out will be yesterday's pivotal resistance level, now turns into a resistance for this potential minor bounce that could take shape in first step. So i.e. using 64 figures / 63.90 as my short-term pivotal support level, flip to a bullish bias for a minor recovery scenario that may take shape for today. First resistance zone to watch, or very 64 or area 64.55 / 64.60. Only a bullish breakout above 64.60 may see a much more pronounced minor recovery to visit the next intermediate resistance at 64.80 next. However, if we start to see a bearish breakdown and the hourly close below 63.90, then potentially we must start to see a much more pronounced Aussie dollar weakness, exposing the next support level, which in short term will be at 63.73 or 63.70 if we were to round up over here. That is the minor swing low of 23rd of July. 23rd of June, pardon me, not 23rd of July, 23rd of June, which is this form where it managed to see a minor V-shaped recovery then. Okay, so this will be the next support level to watch if 63.90 is not able to hold. All right, so that's for the Aussie dollar. Next up will be the Japanese yen, the dollar yen. So the dollar yen continues to inch down lower below that 20-day moving average, but still can't break below a 50-day moving average, I think, as a support in this first support zone that we highlighted yesterday, which is 146.70 / 146.40, which is the minor swing low of 14th of August. So it's like a key near-term support zone. But however, what we could see is that since price action still remains below this rejection level, which is the 20-day moving average, that has been a significant intraday resistance level since 15th of August. So I still got to respect this level. Unless this level is taken out on the upside, then potentially you may see a squeeze. So it may continue to trade within this minor range configuration within a medium term ascending range configuration that is still in place since 22nd of April. So it's something like a range within a range right now for the dollar yen. So using 147.85 as my short-term pivotal resistance level, so I'll still maintain that bearish bias within this minor range configuration that has taken shape since the low of 14th of August. First support level to watch still remains unchanged at 14670/40. So only a bearish breakdown below 14670, then this dollar yen may be exposed to much more intraday weakness potentially to visit the next near-term support level in first step at 14585, which is the minor swing low of 24th of July. However, if we have a bullish breakout above 14785, then potentially the dollar yen may see a squeeze up towards the upper limit of that ongoing medium-term ascending range configuration, with the next resistance coming in at 14875, followed by 14950. So that's for the dollar yen. Next up will be the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continues to do a intraday whipsaw between the 20-day moving average over here. So yesterday, it actually, at the start of the Asia session yesterday, it actually dipped down below the 20-day moving average. And as the session progresses yesterday, it managed to go back up above the 20-day moving average and continues to trade sideways in the entire European session, heading into the US session as well. So what we could see over here is a very messy sideways choppy range configuration, I would say. So with this messy sideways choppy range configuration, right now in terms of directional bias, I got no conviction at all at least in the very short intraday time horizon. So with that, very clearly there's an intermediate resistance at 25,270 that has been acting as a resistance since the test of it on this Monday, and that's considered as currently the intra-week high as well. So with that, I will flip to a neutrality stance for the Hong Kong 33 that is representing the Hang Seng Index at 25,270 and 24,915, which is a very interesting near-term support level, where yesterday's start of the Hong Kong trading session, it managed to find a bounce of it, but this bounce is unable to gain traction and starts to trade sideways through the entire European and US session yesterday. So neutral between 25,270 and 24,915 for now on the Hong Kong 33. Next up will be the Japan 225. So for the Japan 225, yesterday we flipped to a bearish bias because it broke down below that pivotal support that I highlighted on Tuesday. So I'm going to respect the latest price action. So price action has started to inch down lower as expected. So yesterday, during the start of the US session, it printed a low of 42,572, which is very close to our support level that we highlighted yesterday at 42,113, 42,460, which is that former all-time high area as well. And what's interesting is that it starts to print this lower low over here, lower low. The RSI starts to slope up, form a higher low at the oversold region. All right, so indicating that yesterday's intraday downside momentum has started to ease off slightly above where price actions almost hit our short-term support area that we highlighted in our bearish bias, our first support area at 42,513, 42,460. So with that, I will flip to a short-term intraday bullish bias stance, given this positive element that has taken shape right now on the hourly RSI. So I got to take note of the latest price development. It's on a very shorter term basis. So flip to a bullish bias stance using 42,513, 42,460 for the Japan 225, pardon me, which is representing the Nikkei 225. First resistance level to watch for today will be 43,060. Above 43,060 may potentially seek out the next intermediate resistance level at 43,470 next. Only a bearish breakdown below 42,460 will invalidate today's minor recovery scenario and the bullish bias to see the extension of this ongoing corrective decline sequence unfolding further to the downside to retest the rising 20-day moving average that is converging at the next intermediate support zone, which is 42,100, 41,760, right, which is the minor swing high of 24th of July 2025. So that's for the Japan 225. Next up will be the Germany 30 that is representing the German DAX over here. So it continues to trade sideways over here, but still holding above the pivotal support at 24,515. So no change as it continues to kind of they do this kind of minor sideways consolidation. So I still got to actually respect these two levels that are still in play for the Germany 30 as well. So what we could see over here is that 24,155 will still be my short-term pivotal support level I have for the Germany 30. So first resistance level to watch will be 24,440. So a bullish breakout above 24,440 will increase the bullish conviction for a recovery to retest 24,570 in the first step. Above it, potentially seek out the next resistance level at 24,730, which is a brand new all-time high defined by a Fibo extension level at 1.382. So however, if price action starts to break down below 24,155, today's bullish bias will be kind of invalidated to see a deeper or a corrective decline sequence extension to retest or to expose the next near-term support level at 23,990, which confluence with the 50-day moving average as well. That's for the Germany 30. Next up will be the US Wall Street 30, that's representing the Dow Jones Industrial Average. So the US Wall Street 30 also continues to be held above our pivotal support level, which is 44,715, but can't break above that 45,100, which was the former all-time high and our kind of an upside trigger level as well to increase the probability of the bullish conviction. So yesterday it almost hit that level at 45,100, printed a high of 45,052. Give or take, it's almost very close to this level. So for sure it got to break out above 45,100 level to increase the probability of the bullish scenario to unfold the US Wall Street 30. So level still remains unchanged on the US Wall Street 30, still using 44,715 as my short-term pivotal support level. A breakout above this 45,100 level will increase the probability of this bullish bias conviction to expose the next near-term resistance level at 45,455, 45,520. Only a bearish breakdown below 44,715 will invalidate this bullish bias to see another round of minor corrective decline sequence unfolding, exposing the next near-term support level at 44,470, 44,420 next, which correspond to that rising 20-day moving average as well. Next up will be the Nasdaq 100. So the Nasdaq 100, yesterday we pinpoint a pivotal support at 63.70, 63.50, which is the lower limit as well of this ongoing medium-term ascending channel that is still intact since the low of 23rd of May over here. So price action managed to did a bounce as expected on this pivotal support zone on the SPX 500. So without doubt, I still got to respect this level over here since it managed to hold this level yesterday. And a new interesting development on the hourly RSI is that it managed to do a bullish breakout from this former parallel descending trend line, indicating that some signs of short-term bullish momentum has started to creep back into the S&P 500. So given this slew of positive development that has taken shape on the SPX 500, I'll still maintain that bullish bias using this key short-term pivotal support zone at 63.70, 63.50. First resistance level to watch will be 64.40, followed by 64.66. Only a bearish breakdown below 63.50 will invalidate today's bullish bias to see another round of corrective decline sequence extending further to the downside, exposing the next support level at 62.94. A breakdown below it may seek out 62.63, which confluence or coincide as well with the rising 50-day moving average. Next up will be the Nasdaq 100. So Nasdaq 100 yesterday we have a kind of a very neutral element, and also we have a mixed element in the very short term basis. So we flipped to a neutrality stance yesterday. So yesterday the Nasdaq 100 broke down below our neutrality level and hit the support level at this 22,970, 22,945. We also correspond to the rising 50-day moving average. So you notice that over here, give me a minute. The Nasdaq 100 is slightly weaker than the S&P 100. Why? Because price action is still trading below the 20-day moving average, whereas the S&P 500 has starts to inch back up above the 20-day moving average as we are speaking right now. All right. So now back to the Nasdaq 100 again. And what's interesting over here is that where it bounces off exactly slightly above the 50-day moving average, and exactly at this medium, this level here as well, which is the, if you go to the weekly time frame, is the former long-term, is the former long-term ascending channel upper limit that is taken from the pandemic low of 16th of March 2022. And after that, it did a bullish acceleration on 14th of July. And right now, there's a retest at this significant formal long-term ascending channel resistance now turns into a interesting pullback support level on the hourly basis. All right. And also confluence right exactly at the rising 50-day moving average, making it as a important medium-term pivotal support area. And what's interesting over here is that the hourly RSI also shaped that bullish breakout as well from this parallel descending trend line, indicating some form of short-term intraday bullish momentum that has crept back into the Nasdaq 100. So with that, today we'll flip to a bullish bias for the Nasdaq 100. 22,960, 22,945 will be my medium-term pivotal support level. First resistance level to watch will be 23,420, which correspond to the 20-day moving average. Above it, potentially seek out 23,660. We also correspond to this minor descending trend line that is still in place since the fresh all-time high of 13th of August. However, a price action breakdown below 22,945 and the hourly close below it will invalidate today's intraday bullish bias to see the extension of the corrective decline sequence unfolding, exposing the next near-term support level at 22,680, which is the minor swing low of 1st of August. Below it may seek out the next near-term support level at 22,420, which is the minor swing low of 30th of June to 2nd of July. So that's for the Nasdaq 100. All right. Next up will be the commodities asset classes, starting with gold XAU/USD. So for gold XAU/USD, price action still remain lackluster below our pivotal resistance level that we highlighted, which is so confluence with the 20-day and the 20-day and the 50-day moving average over here. All right, the 20-day in pink and the 50-day in blue. All right. So what's interesting over here is that while making a minor higher high yesterday, the hourly RSI shaped a bearish divergence after hitting the overbought level and exit from it. So indicating the lack of upside momentum as price action got rejected at the 20-day and the 50-day moving average. So still maintain that bearish bias on gold XAU/USD using a short-term pivotal resistance level at 33,407/3352, which is yesterday's minor swing high. First support level to watch will be 33.27. A breakdown below it may revisit 33.10 next, which is very close to the minor swing low of yesterday as well. Only a bullish breakout above 33.52 may potentially see gold XAU/USD to float up towards the upper limit of this medium-term complex sideways range configuration that is in place since the fresh all-time high of 22nd of April, for the next intermediate resistance to come in at 33.59, followed by 33.73 next. So that's for gold XAU/USD. Lastly will be the West Texas oil. So the West Texas oil yesterday did a bounce over here, but the bounce kind of petered out at the same pivotal resistance that we have since Monday this week. So 63.85, 64.18 will still be my short-term pivotal resistance zone to watch for West Texas oil, and that also correspond to the upper limit of this minor descending channel that is still in play from the high of 31st of July. So first support level it got to break will be at 62.50. So 62.50 has been a support since Monday this week. Every time it tested, there's a bounce. So there was a bounce. There was almost a test again yesterday as well during the Asia afternoon session before bouncing throughout the European and US session. So a breakdown below 62.50 will increase the odds of this bearish bias to open up scope for the next near-term support to come in at 61.30, which is the 2nd of June gap up area, and the one-time Fibo extension as well, taken from the high of 31st of July. A bullish breakout above 64.18 will invalidate today's intraday bearish bias to see a squeeze up towards 64.85, followed by 65.60, which confluence with the downward sloping 20-day moving average. All right, so that sum up today's intraday technical outlook on all the broad-based cross asset classes. So before we go, let's take a look at the economic calendar. What are the other key data to look out for today? So today will be a synchronized release of the flash PMI data for services and manufacturing for the month of August in the major developed economies. So at the 3:30 p.m., we'll see the release for Germany, and at 4 p.m., we will see the release for Eurozone, that is the manufacturing PMI and services PMI flash data for August. So that could potentially influence the euro dollar, the euro crosses, and the Germany 30 CFD index. Then followed by 4:30 p.m., we have the release of the UK one, which is the manufacturing PMI flash data and the services PMI flash data for the month of August as well. That could influence the sterling dollar, the sterling crosses, and as well as the UK 100 CFD index. Then thereafter, before the start of the US session, we have one Federal Reserve official speaking, 7:30 p.m. Fed Bostic, he'll making a speech. Then thereafter will be a rather quiet session, followed by quiet time hour, followed by 9:45 p.m., 15 minutes after the start of the US session at 9:30, we will have the flash data, manufacturing flash August PMI data for manufacturing and services for the US economy. So that could potentially influence the major US stock indices and in some form the US dollar as well. Then we will have at 10 p.m. the release of the conference board leading index as well, something to take note of because this is considered as a tier 1 leading economic indicator to kind of gauge the health of the US economy. So for the consensus, they expect a slight improvement from the previous June print of negative 0.3% to negative 0.1%. So that could potentially influence the major US dollar pair and the major US stock indices. So that's 10 p.m. Singapore time, the release of the conference board leading economic index for July. Then thereafter will be a rather quiet session. And before the start of our tomorrow daily dose, we have the release of Japan inflation data at 7:30 a.m. So this time around, market is expecting the core inflation rate to come down slightly below expectation, slightly below the previous month print of June, which is at 3.3%. I expect to dip down slightly lower to 3%, but still still holding a rather at an elevated level above Bank of Japan 2% target. So market will also be focusing on the core rate, core inflation rate, where it's stripping off energy as well as fresh food. Is still hovering a rather high rate at 3.4% previously in the month of June. All right, so that could potentially influence the dollar yen, especially, and the yen crosses. So with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.